May 11, 1931, 2015 p.m. Vienna. Franz Rintelmann, deputy governor of Austria's central bank, watches through his office window as a line of depositors stretches 3 blocks down Schottengasse. They want their money. All of it. What Rintelmann doesn't know is that he's witnessing the first 72 hours of Europe's financial apocalypse. The bank they're rushing to empty isn't just any institution. It's Creditanstalt für Handel und Gewerbe, Austria's financial colossus, founded by the Rothschilds in 1855 and controlling 70% of Austrian industry by 1931. In 3 days, depositors will withdraw 1 billion shillings. The bank will collapse. And with it, the economic stability of an entire continent. This is the forensic financial history of how the world's oldest banking dynasty lost everything in exactly 72 hours, and how that loss triggered a chain reaction that would reshape global finance forever. To understand the magnitude of what collapsed, you need to understand what Creditanstalt had become by 1931. This wasn't simply Austria's largest bank. It was Austria's economy, condensed into a single institution. The numbers tell the story. Creditanstalt controlled 229 companies across the former Austro-Hungarian Empire. It owned steel mills in Styria, coal mines in Silesia, sugar refineries in Bohemia, and textile factories from Prague to Trieste. The bank held 700 million shillings in deposits, representing roughly 1/3 of all Austrian bank deposits. Its balance sheet totaled 1.3 billion shillings, equivalent to 40% of Austria's entire gross domestic product. Behind this empire stood the Rothschild name. Baron Louis von Rothschild served as the bank's president, representing the 5th generation of Europe's most powerful banking dynasty. The Rothschilds had survived the Napoleonic Wars, financed railways across Europe, and managed government debt for half the continent's monarchies. They had weathered every financial crisis for over a century. But here's where it gets worse. What the public didn't know in May 1931 was that Creditanstalt had been technically insolvent for over a year. The bank's troubles began with Austria itself. The 1919 Treaty of Saint-Germain had carved up the Austro-Hungarian Empire, leaving Austria as a landlocked rump state with 65 million people, and an economy designed to serve 54 million. Industrial capacity exceeded domestic demand by a factor of 8. Export markets had disappeared behind new national boundaries and tariff walls. Creditanstалт's response was expansion through acquisition. In 1929, under pressure from the Austrian government, the bank absorbed its main rival, the Creditanstalt. The merger created a financial giant, but it also buried 140 million shillings in bad loans deep within Creditanstалт's balance sheet. The Rothschilds knew about the losses. They chose to hide them. The concealment required creative accounting. Creditanstalt listed worthless industrial investments at full book value. It carried loans to bankrupt Hungarian and Czech companies as performing assets. It used profits from healthy subsidiaries to cover losses from dying ones. On paper, the bank showed steady profits through 1930. In reality, it was bleeding capital every quarter. What nobody expected was how quickly the deception would unravel once it started. The trigger came from an unexpected source, a routine audit. In March 1931, Wilhelm Reich, a mid-level bank examiner from Austria's central bank, began reviewing Creditanstalt's books as part of standard regulatory procedure. What he found were discrepancies that didn't add up. Industrial loans listed as current hadn't received payments in over 18 months. Real estate holdings were valued at 1928 prices despite a property market collapse. Most damaging, the 1929 merger with Creditanstalt had been accounted for using asset values that no longer existed. Reich's initial report, dated April 2, 1931, identified at least 85 million shillings in questionable assets. A follow-up review raised the figure to 120 million skillings. But even these numbers understated the problem. The real losses would eventually total over 200 million shillings, wiping out the bank's entire capital base of 125 million shillings twice over. The Austrian government faced an impossible choice. Creditanstalt was too large to fail, but too insolvent to save. A bankruptcy would instantly destroy 40% of Austria's banking system and trigger mass unemployment across Central Europe. But a bailout would require resources Austria simply didn't possess. Chancellor Otto Ender's government was already running a budget deficit of 230 million shillings annually. The central bank's foreign currency reserves totaled just 180 million shillings, barely enough to cover 3 months of imports. Austria couldn't print money to solve the problem because the shilling was pegged to gold under the international monetary system, and any attempts to break the peg would trigger immediate capital flight. On May 8th, the government announced a compromise solution. The state would inject 30 million shillings of new capital into Creditanstalt, and the Rothschilds would contribute another 30 million. In exchange, the bank would write off its bad loans and continue operating under state supervision. The announcement backfired spectacularly. Instead of restoring confidence, it confirmed depositors' worst fears. If Creditanstalt needed a government bailout, how bad were the losses? If the Rothschilds were diluting their ownership, what did they know that the public didn't? The run began at 9:17 a.m. on May 11th, exactly 72 hours after the bailout announcement. Hans Müller, a Viennese shopkeeper, was among the first to arrive at Creditanstalt's main branch on Schottengasse. His account held 2,400 shillings, his life savings. Müller had read about the bailout in the Neue Freie Presse that morning and decided he wanted his money in cash, not promises. By 10 a.m., the line behind Müller stretched past the Schottenkirche. By noon, it reached the University of Vienna campus 6 blocks away. Depositors clutched account books and withdrawal slips, many written in the pre-dawn hours after sleepless nights. The mathematics of the run were brutally simple. Creditanstalt held 700 million shillings in deposits, but kept only 50 million shillings in cash reserves. Following standard banking practice of maintaining roughly 7% liquid reserves, under normal circumstances, this was sufficient. Daily withdrawals typically totaled 2 and 3 million shillings, easily covered by incoming deposits and maturing loans. May 11th was not normal. By 4 p.m. closing time, depositors had withdrawn 127 million shillings. The bank's Vienna branches were cleaned out of physical currency. Emergency shipments of banknotes from the central bank kept the doors open, but barely. May 12th brought worse numbers. Withdrawals reached 186 million shillings as word spread beyond Vienna to Creditanstalt's 67 branches across Austria. Provincial depositors arrived by train and bus, many traveling overnight to reach the nearest branch office. In Graz, Austria's second-largest city, the local Creditanstalt branch ran out of cash by 2 p.m. and closed early. But here's where the real damage began. The bank run wasn't confined to retail depositors. Corporate customers began demanding their funds, and these withdrawals dwarfed individual accounts. Steyr, Austria's largest automotive manufacturer, held 18 million shillings on deposit with Creditanstalt. On May 12th, company treasurer Rudolf Koppel ordered the entire amount transferred to Swiss banks. Alpine Montan, Austria's steel conglomerate, moved 24 million shillings to London banks the same day. Most devastating was the flight of foreign deposits. German banks alone held 90 million shillings at Creditanstalt, funds they'd placed there to earn higher interest rates than available in Berlin. As news of the crisis spread, German bankers pulled their money en masse, executing transfers to international wire networks. By May 13th, total withdrawals reached 312 million shillings over 3 days. But the hemorrhaging extended beyond deposit outflows. International credit lines were frozen, as foreign banks refused to roll over short-term loans. Currency speculators began attacking the Austrian shilling, forcing the central bank to sell gold reserves to defend the exchange rate. The numbers tell a different story than the government's public optimism. While Chancellor Ender publicly insisted that Creditanstalt remained solvent, internal government documents reveal panic at the highest levels. A confidential memo from Finance Minister Georg Bursch to the central bank governor, dated May 13th, admitted that deposit outflows had reached catastrophic proportions and that the bank required immediate injection of at least 100 million shillings to survive another week. Austria didn't have 100 million shillings available. At 3:47 p.m. on May 13th, exactly 72 hours after the bank run began, Baron Louis von Rothschild walked into the office of Central Bank Governor Victor Kenbach and formally requested that the government take full control of Creditanstalt. The Rothschild era was over. The immediate aftermath was swift and merciless. By May 15th, Creditanstalt had declared a moratorium on all deposit withdrawals. The Austrian shilling fell 12% against the pound sterling in a single trading session. Vienna's stock exchange suspended trading indefinitely. But what nobody expected was how rapidly the crisis would spread beyond Austria's borders. The contagion mechanism was debt. Creditanstalt owed money to banks across Europe, and those banks suddenly faced massive losses on their Austrian exposures. German banks held 200 million Reichsmarks in claims on Austrian institutions. French banks were exposed for 180 million francs. British banks had lent 15 million pounds to Austrian borrowers. As these foreign banks recognized losses on their Austrian loans, their own depositors grew nervous. Why should German savers trust banks that had lost fortunes in Vienna? The logic of financial contagion began spreading eastward across Central Europe. The Dynasty Bank in Berlin, Germany's fourth largest bank, failed on July 13, 1931, exactly 2 months after Creditanstalt collapse. The connection was direct. Dynasty Bank had extended 47 million Reichsmarks in credit to Austrian companies, most of it channeled through Creditanstalt. When the Austrian bank failed, these loans became worthless, wiping out Dynasty Bank's capital. Germany's banking crisis triggered runs on banks across Central and Eastern Europe. Hungary's largest bank, the Hungarian General Credit Bank, suspended payments on August 1st. Romania declared a banking moratorium on August 15th. Poland imposed exchange controls on September 2nd, trapping domestic savers inside a rapidly depreciating zloty. The British pound, seemingly immune at first, came under attack in September 1931. International investors reasoned that if European banks were collapsing, British banks with European exposures might follow. Gold flowed out of London at a rate of 2.5 million pounds per day. On September 21st, Britain abandoned the gold standard, allowing the pound to float freely and depreciate. The numbers from this cascade are staggering. Between May and December 1931, industrial production fell 23% in Germany, 31% in Austria, and 18% across the European continent. Unemployment in Germany rose from 3.1 million to 4.9 million workers. International trade contracted by 25% as countries imposed tariffs and exchange controls to protect their currencies. But this is where the story matters for understanding modern banking. The Creditanstalt collapse revealed how tightly interconnected the global financial system had become by 1931, and how quickly confidence could evaporate once it started to crack. The bank's failure wasn't caused by a sudden external shock like war or natural disaster. It was caused by the exposure of losses that had been accumulating and concealed for years. When depositors finally learned the truth about the bank's condition, they acted rationally by withdrawing their money. But their rational individual behavior created collective catastrophe. More importantly, the crisis demonstrated how government guarantees and central bank support could fail when the scale of the problem exceeded the resources of the state. Austria's government had promised to save Creditanstalt, but Austria was too small and too poor to make good on that promise when the crisis hit. The parallels to more recent financial crises are unavoidable. The 2008 collapse of Lehman Brothers followed a similar pattern. Years of hidden losses, sudden exposure, rapid confidence collapse, and international contagion. The 2023 failure of Silicon Valley Bank demonstrated how quickly modern technology can accelerate bank runs, with depositors withdrawing $42 billion in a single day through digital transfers. What survived the Creditanstalt collapse was the understanding that banks are fundamentally confidence-based institutions, and that confidence, once lost, can rarely be recovered quickly enough to prevent catastrophe. The Rothschild banking empire, which had dominated European finance for over a century, never recovered its former position. Baron Louis von Rothschild was arrested by the Nazis in 1938 and held for ransom until his family paid what historians estimate was the largest ransom in history. The Austrian branch of the family dispersed to London and New York, their Central European assets seized or sold at distressed prices. Creditanstalt itself was nationalized and eventually merged into other state-owned banks. The Austrian shilling, once a stable currency backed by industrial might, remained weak and crisis-prone until Austria joined the European Monetary Union in 1999. The country's financial sector never regained its role as a bridge between Western and Eastern Europe. The broader lesson extends beyond banking to the nature of financial power itself. For 76 years, from 1855 to 1931, Creditanstalt had seemed unshakable. It had survived the assassination of Archduke Franz Ferdinand, the collapse of the Austro-Hungarian Empire, hyperinflation, and the Great Depression's early stages. The bank's shareholders, employees, and depositors had every reason to believe it would survive indefinitely. Yet when the end came, it took exactly 72 hours, 3 days to destroy what had taken 3 generations to build. The speed of the collapse reflects something fundamental about financial systems. They depend on collective belief, and collective belief can change faster than any institution can adapt. Modern technology has made this process even faster. In 1931, it took 3 days for depositors to line up at bank branches and withdraw their money. In 2023, Silicon Valley Bank's depositors moved $42 billion through smartphone apps and wire transfers in less than 24 hours. Today's largest banks are far larger relative to their national economies than Creditanstalt was to Austria in 1931. JP Morgan Chase holds assets worth roughly 17% of U.S. GDP. China's Industrial and Commercial Bank of China controls assets equivalent to 20% of Chinese GDP. The European Central Bank estimates that the failure of any of Europe's 6 largest banks would immediately threaten the stability of the entire European financial system. These institutions benefit from government guarantees and central bank support that didn't exist in 1931. Deposit insurance, lender of last resort facilities, and too big to fail doctrines are designed to prevent the kind of runs that destroyed Creditanstalt. But they also create moral hazard, encouraging banks to take larger risks because they expect government rescue if those risks go wrong. The Austrian crisis of 1931 demonstrated that no institution, no matter how powerful or how long established, is immune to the mathematics of confidence collapse. When depositors, creditors, and counterparties lose faith simultaneously, even the strongest balance sheet can be overwhelmed in a matter of hours. That lesson remains as relevant today as it was 92 years ago, in an era when the world's largest banks are bigger, more interconnected, and more systematically important than the Rothschilds' financial empire ever was.